Starting to record. So thanks for coming to SIP call number 6, 29th of July, 2022. So today we have a special guest, Matty, here to show us and talk to us about his report on the stacks mining and suggestions how we can improve the decentralization of mining. So yeah, cool. So just for those who haven't been here before, like a quick catch up on what this call is about. So this call is to inform the community, not just live on this call, but there will be recording that goes out so that everybody can watch afterwards if they cannot attend live, about the SIP status, where, you know, whether it's conversation, early conversation through to things that are happening midway through the SIP, or later on in the journey of SIPs that is ready for activation. And here is a place where you can also share your idea, share your proposal, get some feedback, gauge some interests. Yeah, so here is a great place. Lots of very smart people attend. So yeah, feel free to join and use this space, and we'll have like regular guests coming to talk about stuff, and also like we'll try to host like meetings where people can discuss important topics such as mining, such as BD's derivation path, etc. So a quick SIP update. I see a cross join. So what's going on in the SIP world? So the later stuff that it's in the pipeline, sort of later stages stuff that's almost been ratified. There are 3 things that are already at very late stage of activation in progress. SIP 16, 18, 19, if you want to read more about them, yeah, GitHub is a great place. And SIP 13 is one that's at accepted stage. And I hope, because I'm going to rally all the CAP members very soon, and I already started. So I'm hoping to test this SIP 13 with our CAP groups. So stay tuned for that. And I'll be gathering SIP editors as well. Yeah. So next stage. So there are still early drafts actually of SIPs. One that's quite good, and also sort of quite popular, I guess, is Fridger's authentication, whatever, protocol that's basically to do with like verifying credentials with the profile in the wallet. So wallet having profiles that you verify different stuff with, and I guess setting some sort of standard for that. So I think Hero is doing something with that. So we'll get him to talk more about that. And also I've been chatting with him about whether we can use some sort of reputation stuff for the SIP voting. So yeah, I think there's a lot of opportunity with this. So if you want to know more, please go and check out this SIP. And there are earlier stage stuff that's happening on SIP, on Stacks forum. So I think the way to think about it is, I think Stacks forum is you can have those earlier ideas, brainstorms, asking people for comments, and then when it gets to later stage where you feel it's like more or less ready, then you post it on GitHub So the earlier stuff that happening right now that I think are quite interesting is the Bitcoin derivation part one, and also the super important one, there's a minor centralization. BNS also kind of very interesting. That's worth touching on. And all this stuff are at the early stage. Some of them proposed by Ryan are all very interesting. But I do, next week, I do think I want to try and get Ken to come on and talk about his Bitcoin addresses stuff, which I think has a big unlock for Bitcoin NFT with Bitcoin addresses and Bitcoin DAO. So yes, they're all on Stacks Forum. Just to catch up on like previous week stuff, just to make everybody aware what type of stuff conversation goes on here. If you only joined the first time, like Brian. So previous weeks were about like decentralization of mining, also the SIP voting process to make it more decentralized, include more people, and a bit of explanation about the SIP process. And ecosystem DAO is something Marvin is working on, which is like a next level from the executor DAO, which has more functionality and modularity for creating a DAO, so that the creators can really step away from the original thing. Stu talked about Stacks 2.1 a couple of weeks ago. That's really important. That's coming very soon, in the next few months. We'll have more talks about Stacks 2.1 for sure. Yes, and also we touched on the derivation part. And last week we had Rena from Trust Machines to come talk about Taproot integration, which will also be part of 2.1. So I will give the floor to Matty for his presenting his miners report.
Thanks, Hero. Should be able to hear me, and I'm going to share my screen here and just let me know it's all working correctly. Give me 1 second. Okay. Can you see the screen?
Yep.
Okay, awesome. Cool. So like Hiro mentioned, I have compiled a report on the last year of Stacks mining. For those not familiar, Stacks mining has its own consensus mechanism, right? Proof of transfer. I dropped a Twitter thread into the chat. It's also in this report that goes much more into detail about Stacks' relationship with Bitcoin and how proof of transfer works and how attacks work. But basically, the high level principle is that the only way to mine Stacks is the act of writing Stacks' history onto the Bitcoin blockchain. So the Bitcoin blockchain secures the Stacks chain. That's the only way to create, mint, mine new Stacks tokens. And process transactions. And so that dynamic is why Stacks is Bitcoin, smart contracts for Bitcoin. The way that works is basically miners send Bitcoin transactions into this pool, into this function for a chance to win a block. Very similar in principle to how proof of works, right? Proof of work works. In proof of work, people do computations for chance of winning a block. So similar concept here. It's basically, you can think of it as reusing Bitcoin's proof of work. People send in Bitcoin by sending Bitcoin transactions to get a chance of winning a Stacks block. They win the Stacks blocks. They get to say what is in that block. And so the more competitive that process is, just like in proof of work mining for Bitcoin itself, the more decentralized Stacks is, and the harder it would be, and the more costly it would be, and the more difficult it would be for someone to maliciously try to mess up the Stacks blockchain, or revise it to like send themselves a bunch of stacks, or whatever the case may be. So that's the high level of how mining works and why this matters. And so let's dive in to kind of some of these findings. Again, I looked at the last year of mining activity, looking at mining commits. So what were people sending for mining, and also what were they winning as mining rewards? Just like mining Bitcoin, right? People get coin-based rewards for mining a block. The Bitcoin transaction fees. So because Stacks mining is the process of sending Bitcoin transactions, just like every single Bitcoin transaction, right? You have to pay gas fees with those Bitcoin transactions. So gas fees is kind of a fixed cost when you're mining Stacks. Also looked at the Stacks gas fees earned per block. So this should not be confused with the Bitcoin gas fees. So when I send a Bitcoin transaction, I pay gas fees. So I send a Bitcoin transaction to mine Stacks. But people using Stacks are also making lots and lots of transactions, right? They're making trades, they're minting NFTs, they're placing bids, they're entering into smart contracts. All those require Stacks gas. And that Stacks gas is earned by the Stacks miners. So this Stacks gas is income to the miners. And then I also looked at market prices for Stacks and Bitcoin, because ultimately, if you want to express the profitability on a apples to apples basis from the point of view of a miner who cares about instant arbitrage, right? Am I paying less in Bitcoin than I'm getting in value worth of Bitcoin? You need to express them both on an apples to apples basis in sats. And so the market prices at a given time a block was mined is relevant. So just at a high level, it was interesting to know, one of the first things I found was that, Bitcoin blocks happen on average every 10 minutes by design, right? And Stacks, in theory, happens, a Stacks block occurs at the same exact rate as Bitcoin blocks, right? Because Stacks is secured by Bitcoin. However, there are occasions where a Stacks block is not mined in a Bitcoin block. It could be like a flash block for Bitcoin, where it's not really a problem per se. It just means that there's slightly slower confirmation times on the Stacks chain. Doesn't mean that there's any loss of information or any additional risk or anything like that. On the contrary, it's actually less risk. But there is a slower confirmation time. And so on average, a Stacks block is mined about 11.6 minutes per block, which leads to about, pretty neatly, math leads to about 124 blocks per day. And over a year, that's about 45,000 blocks. And so this is looking at that period of analysis. The first big observation was that on average, typically, there are 7.3 miners a day. So that's this blue line here. So the median value per day is about 7.3. It's ranged from as few as 5 very brief time periods to as high as very briefly 11. But typically, there are 7 distinct miners mining Stacks. Now, just like with Bitcoin, we want to ask ourselves not just the total number of miners, but the distribution of those miners, right? In Bitcoin, for example, if you had 100 miners, but one of those 100 miners had 60% of the total mining power, that miner could make a 51% attack, right? They could reorg the Bitcoin blockchain. They could basically propose a new chain that takes over the place. So 51% attack is relevant both to Bitcoin and in theory to Stacks. We can talk about that later. There's other additional defenses beyond just purely 51% of the power, the bid power in any given block. But it's a relevant concept, right? So when you think about the decentralization and the security of Stacks, it's not just the total number of miners that matter. It's as much, if not slightly more important even, the number of miners it takes to hit 51%. Because if it's only one miner, then that miner can attack the blockchain. If it's 2 miners, then it only takes 2 of them to kind of team up and attack the blockchain. If it takes 3, et cetera. If it takes all 7 of them to team up and attack the blockchain, then that's obviously going to be very hard to do in reality, when people don't even know who the other miners are. They don't know if they're going to be try to go behind each other's back. And so the larger that number is, the safer the network is. That number, if all the miners are equal size, will be half of the total number of miners, right? Because if you have 10 miners and they're each doing 10% exactly, then it takes 5 of them, right? Well, 6 of them to get over 50%, right? But if you have 10 miners and they're mining at different sizes, where maybe 3 of those miners are mining 20% each, so 60% total, and then the rest of the 7 miners only mining 40% total between them, then you only need 3 of them to hit above 50%, right? The 20%, the 20%, the 20%. And so this number on average has worked out to be 3.7 miners required to execute a 51% attack. That is half of the total number of miners, but it's important to point out that that doesn't necessarily need to be the case. The number of this orange line number being half of the blue line number indicates that on average, the miners mining are roughly the same size. It's more like the 10 miners mining 10% each type of case than it is the 10 miners where 3 of them are mining 20% and the rest are mining 20% each, and the rest are mining 40% total. So it's more like the miners are equal size roughly. So moving on. Another important finding was that most people who know about stacks mining know that there's a coin-based reward, right? So when you mine a Bitcoin block, you get a coin-based reward, right? You get a certain number of Bitcoins, and as halvings happen, that number decreases. Same concept applies to stacks. If you mine a stacks block, you get a coin-based reward. That coin-based reward is currently 1,000 stacks. But there's a subtle nuance here where that 1,000 stacks is actually per Bitcoin block, not per stacks block. The reason it's per Bitcoin block is because if stacks misses a block, you don't, or if stacks is so low in price that no one wants to bid on a given block, you want those benefits to aggregate so that eventually the payoff is so high, someone will mine a stacks block. And so this ensures that stacks will always be mined no matter what. But that means that when stacks skips a block, as we saw, right, when we talked about the frequencies, that rewards accrue. And so you'll notice that about 7% of blocks, 6.6% of blocks actually have higher than 1,000 stacks rewards. And so that actually means what that's resulted in is that coin-based rewards are actually on average 1,070, 1,071-ish stacks per block, meaning that mining is 7.1% more profitable than would just first appear if you just do a quick back of the envelope. Oh, it's 1,000 stacks per block reward. Oh, it's 5% unprofitable. Actually, it's more like 2% profitable if you're just doing that quick back of the envelope math, and that's the reason why it's not right. Finding number 3 is that miner rewards, remember that miners earn the Coinbase reward and they earn the gas fees that you and I and everyone else using the Stacks network are paying when we make a transaction. Those all are earned by miners. Now, that portion of total rewards that's coming from Stacks gas fees is rather small. It's about 1.3% of the total rewards that miners are making. Now, at periods, like a Megapont mint or the robots release or various different kind of periods of congestion where usually around like NFT mints is from what I've seen at least, fees have shot up, and at their peak they have been about 10% of the total miner rewards. But there's still a relatively long way to go before Stacks gas fees represent a significant portion, a significant incentive for miners beyond just the Coinbase reward. This is the same exact dynamic, same problem, by the way, that Bitcoin has, right? Bitcoin's mining incentives, mining rewards are predominantly the Coinbase reward, not transaction gas fees. But this is important to know for Stacks. There's a lot of room to grow before the gas fees become a big motivator for additional miners to come in. Finding number 4 is that despite what you might have heard, despite kind of the common knowledge that mining is unprofitable, actually in aggregate, it has been 13.7% profitable. So that doesn't mean that mining can't be unprofitable. That doesn't mean that mining has periods of unprofitability, right? But it does mean, that doesn't mean that small miners can't mine poorly, right? Just like a Bitcoin miner might lose money due to randomness or luck, or because they have higher costs of hardware or higher costs of electricity, et cetera. Doesn't mean that everyone's making a profit, but it means in total miners are making a profit. And so in total, that profit that miners are making over the last year has been about 13.7% just on Coinbase rewards. And so we can look at that profit margin over time, and you can see, it's obviously fluctuating with the price of Bitcoin, fluctuating with the price of stacks, fluctuating with the amount of miners that are bidding, fluctuating with gas fees that they have to pay to mine. All those things are going into it. It's fluctuating a bunch, but on average, it's about this 13.7% number. And only about, I can't remember, only about 8% of the time is it below this red line at 0%. So only 8% of the time is mining unprofitable. So if we include the gas fees as well, right, we said the gas fees isn't really a big portion of miner rewards, which is true still, but if we include them, it bumps up miner profitability a little bit from 13.7% to 14.6%. Moving on, just a couple more things here to touch on. One of the reasons that, or one of the theorized reasons, I should say, there's a lot of evidence to it, but it is a theory. One of the theorized reasons that more miners don't contribute is that it takes a lot of Bitcoin to mine stacks. There's two contributing factors. One is the amount of stacks you need to simply be bidding to get a chance at winning and do that consistently to smooth out your volatility and prevent bad luck, right? You don't want to spend Bitcoin and then have an expected return of 10%, but only bid on, 3 blocks. And it's very high chance you don't win any of those 3 and you end up with a negative 100% return. The other portion is the gas fees you have to pay per Bitcoin transaction you're sending. And so even though gas fees on the Bitcoin network, so Bitcoin gas fees and sats have been dropping over time, even still, because of what the gas fees are now and because of the profit margin, you would basically have to have an entire Bitcoin in order to mine one full cycle of stacks and expect to break even. And that's a function of the profitability of mining and the amount of gas fees that you have to send for each Bitcoin transaction. And so that's around, Bitcoin's up a bit since this report, but that's around $25,000-ish, right? That you have to commit every 2 weeks, or at least be recycling every 2 weeks just to break even. And so that's obviously like a pretty big barrier to like hobbyists and small-time miners who might want to otherwise get involved. That doesn't even include like what you'd actually want to do to kind of smoothen out volatility and reduce your bad luck. Like have like a 95% confidence interval that you would be at least breaking even. And if you do that, it bumps up to more like 10 Bitcoin per cycle. So there's a big barrier there to small miners. As you might expect, for this reason, it's pretty well known that large miners do profit more, but not primarily because of the gas fees, not because they're paying a smaller portion of their bids than gas fees. So without getting too deep in the weeds here, you can see that the total amount of sats committed, so the bigger the miner is, right, the more money they spent on mining, the more to the right they're going to be on this chart. And the higher their profit margin, not their aggregate profit, but their profit percentage, the higher they're going to be on the y-axis. And you can see a very clear relationship with a decently high explanative power, showing that, yes, larger miners on average expect to have higher profit margins. And so this means that if you're a small, medium miner, you are at a disadvantage to larger miners, all else equal. Now, why does that happen? Is that because of fees? The evidence doesn't seem to suggest that that's primarily because of fees, although fees do play a small portion of that. But interestingly, the most significant factor that explains, your profit margin is actually not your size per block, not your average sats committed per block, so not how big you are in each given block, but how many blocks you mine. In other words, the more consistent you are, all else equal, the more profitable you are. And larger miners are more profitable primarily because they're more consistent, not primarily because necessarily of fees or because they're bidding a ton on a few blocks here and there, but because of their consistency. So that's an interesting takeaway as well. And finally, I wanted to look at, well, what are some ways that we could bring more miners into stacks, right? Are they responsive to like Bitcoin gas fees decreasing? Are they responsive to the Coinbase reward going up? Are they responsive to gas fees as a percent of the Coinbase reward going down? Are they responsive to profit margins, right? If there's a high available profit margin, does that mean there'll be more miners? And largely speaking, the only kind of significant factor was Coinbase rewards and sats. That's reasonably predictive. As you can see here, the higher the block rewards, so as the block rewards and Satoshis go up, the number of miners generally goes up. And so that the implication there is that if Stacks appreciates to Bitcoin, so the Stacks Bitcoin relation goes up, it actually makes room for more miners, which is promising because we all, I think all on this call have a thesis or at least a hope that, as Stacks gets more adoption, more use, like any other asset, it would appreciate based on its usage relative to Bitcoin as well as relative to other assets. And so that in and of itself should bring more miners, but we obviously can't, wait and rely on only that, but that's good to know. Gas fees as a percentage, Coinbase rewards didn't really show anything. And then aggregate profit margins also didn't show much. Aggregate profit margins is interesting because you can have the same like 15% profit margin with only 2 miners versus 10 miners. And so aggregate profit margin is more likely to be a predictor of net change in miners period to period rather than total number of miners at a given time. But that's getting a bit into the weeds. But the biggest takeaway is there doesn't seem to be much that can be done to bring new miners other than increase the Coinbase reward, which means, driving value to Stacks. And then also, obviously, can we create new miners by leveling the playing field between small and medium miners versus larger miners? So that was kind of the conclusions that I came to. So, what is the possible causes that miners don't join, more miners don't join, and what are the causes that are backed by data? Well, there's a lack of tooling and ease of mining. It's not terribly easy or user-friendly, especially for non-technical people to start mining. The fees prevent small miners even from joining. Miners are simply not aware of possible profits. Is quite probable, actually. Like if institutional investors were offered a 13, 14, 15% profit margin, seems quite obvious that more of them would take it. So many of them might not even be aware. There might be some tax implications of mining that do negate some of the potential profits, depending on where you're sourcing your Bitcoin. Higher profit margins skews to fewer larger miners. So the fact that larger miners get higher profit margin is going to result in the situation we have of fewer larger miners. Miners maybe don't care about profit margins as much as they care about aggregate profits. So put yourself in the shoes of a very, very large money manager. You have, $100 million you need to deploy. Are you really going to deploy it $1 million at a time? So is 13% profit on 1 million really even worth your time and trouble to go through the effort versus a 13% profit on being able to deploy, $100 million at once, right? So until the Stacks market gets larger in aggregate size, not in percent size, the profit margin, there might be some big miners that just can't come in until the total market size gets bigger in dollar terms. And then Stacks fees aren't yet a significant source of additional mining rewards. All else equal, if Stacks gas fees were much higher, people were using Stacks more, there were more transactions settling, there was more total gas, that would mean more profitability for miners, which would expect to be increasing the number of miners. And so just to close here, some key takeaways. Obviously, there's a lot of work being done on non-custodial mining pools. Those would be extremely helpful because they solve the problem of the lack of tooling and ease. They also solve the problem of small miners don't have to pay fees, right? Because the fees can be shared by the pool. So the pool can send one transaction for all, 100, 1,000 people in the pool instead of 1,000 different people all paying the same fee. So 1,000x the total fees. So it levels the playing field in fees, it levels the playing field in size and being able to be consistent, and it makes the tooling easier. We also maybe need some higher institutional awareness of Stacks mining. I've actually just recently been contacted after publishing this report by a couple of large Bitcoin miners who are interested in Stacks mining. So doing my part to help on that angle. Increasing general adoption awareness, driving up the Stacks price per Bitcoin would also help. Increasing Stacks gas fees would help. And reducing the profit margin advantage for large miners. So leveling that playing field where in percentage terms of profit, a small miner and a large miner should be getting the same percentage profit is something that a few open ideas for proposals are considering that could also help improve this and bring additional miners. So that's a summary. I think it probably went a little bit longer than was anticipated, but hopefully that was very informative, and I'm happy to kind of answer any questions that anybody has.
Oh, thanks, Maddie. I see a question in the chat. So the question is, if mining stays unprofitable for some time, do we think we would ever have extended period of volatile block times, e.g., miners do not mine for an hour, let rewards accrue since they carry over, then mine for bigger rewards, then repeat the cycle again?
Yeah, it's a good question, but I think in practice, no. What's far more likely to happen is as mining becomes it's kind of like a game of chicken, right? Two drivers, driving at each other head on, seeing which one will turn first. It's kind of like a game of chicken. So if imagine we're miners and we obviously want to make a profit, but we see, okay, mining is going down. Now it's negative 10% profit margin. Well, if you leave first and you stop mining, that's going to increase the profit margin, right? Because you leave, that means there's less competition. So I have a higher chance of winning the block, meaning my expected return is higher. So if you leave, maybe there's only a negative 5% profit margin. And so there's an element of staying in there, even when it's temporarily negative, and kind of like claiming your space, so to speak, is actually a viable long-term kind of payoff strategy. If you look at kind of the game theory and the longer, like repeated gameplay strategy. So it's highly, highly unlikely for multiple reasons you would see all miners pause or drop out of mining for a couple blocks. Like the price of Stacks would have to be absolutely decimated compared to Bitcoin for that to happen. So I don't think it's a practical concern, even though in theory it could happen.
Yeah.
I have a question. Thank you, Matt, for this incredible research. So I understand today that this reward function, which is a function that kind of takes in how much miners commit in BTC to the likelihood or probability that they'll win, I believe that's kind of proportional. What do you think about alternative ways to formulate that function that's perhaps logarithmic or something else that may encourage more diversified and smaller miners, of course, at the expense of larger miners?
Yeah, I think it's interesting. So to rephrase your question, just so everybody listening is on the same page, right now, if you and I both contribute, we'll keep the numbers simple, right? 100 Satoshis, and we're the only miners. That means there's 200 miners committed in total, and we each have 100 out of those 200, we each have a 50% chance of winning. Let's say that you drop your bid to 50. So I'm bidding 100, you're bidding 50. Now there's 150 total. You have a 1/3 chance, 50 over 150, and I have a 2/3 chance, 100 over 150. Obviously, the larger miner has an advantage there, and they have a percentage advantage in profit terms because we're paying the same fixed cost, by the way, to a gas fee. So you're asking if we should basically kind of smoothen that curve where it's not linear. So if we both contribute, or if you contribute 50 and I contribute 100, there's 150 total, but you would get more than 33% chance of winning, and I would get less than 2/3 chance of winning. It would still add to one, but there'd be some kind of curve, some non-linearity that would, in layman's terms, boost the chances of smaller miners at the expense of reducing the chance of larger miners. This is one possible way of quote unquote leveling the playing field between small and large miners. It's actually been discussed. I actually brought this idea up in a forum recently as kind of initial thought on it. I think it's viable. I think it has a couple drawbacks, one of which is depending on how steep that curve is, you start to incentivize large miners to break their bids up into multiple different contributions. So instead of me contributing 100 stacks, I would break my contribution up into 2 different 50 stacks contributions. So now it looks like there's 3 miners, each contributing 50 stacks, but in reality, there's 1 miner contributing 50 stacks and 1 miner contributing 2 different 50 stacks for 150 stacks total. So we don't really want necessarily to create a situation where, you know, large miners have an economic incentive to kind of like behave different, kind of like obscure their behavior. So that's kind of one drawback to that approach. I think a more interesting, or probably a better approach that Ryan has proposed that kind of gets to the same end goal, is to have everyone has to pay the same % gas fees. So if I want to bid 100 stacks, I have to pay, let's say, 1/10 of that in gas fees, so 10 stacks gas fee, right? And so if I'm a small miner who's only bidding 10 stacks, I just pay a 1 stacks a 1 sat 1 sat gas fee to the Bitcoin blockchain. And so it levels the playing field in your fixed cost gas fees. So to answer your question briefly, like that is a possible option. I think it has a couple drawbacks, but that is in the spirit of what we are all considering and kind of weighing as a step forward.
That's what I was going to ask to that last point. I think your takeaway of like the consistency is like the most important. So whether you have a lot of Bitcoin to bid or a little bit of Bitcoin to bid, consistency like is the most important. And so if you have a little bit to bid, but you want to be really, really consistent, yeah, the way to do that would be to pay 1 sat per byte. And so my question was, are the addresses that you have to send your bids to, are those produced one at a time? Like the stacks block, like those addresses are created and then that one gets bid and then the next ones are created, or are they known ahead of time? Because if they're all known ahead of time, then like I should be able to like type in, hey, I want to bid 10,000 sats for the next 100 blocks at 1 sat per byte and send like a batch transaction the same way like an exchange withdrawal. Like when you're withdrawing from, Cash App with 1,000 other people and like they're covering the fee, they're saying send all the X amount of Bitcoin to X amount of addresses, and then they pay a lower on-chain fee too. So that was my question. Like, are the addresses known ahead of time so you could send 1 batch transaction?
Yeah, I think I would need to lean on Jude here. I definitely would say that that's not currently possible, but I'm not exactly sure where the technical limitation is.
Sorry, was the question, are the reward addresses for POX not known in advance?
Yeah, they known in advance. So like, can I bid a low BTC amount with a low, because for my bid to count, it has to be confirmed on chain, right? It can't be in the mempool still.
Correct.
So so that's a disadvantage of bidding 1 sat per byte, because then I don't know when it's going to hit. So that hurts my consistency, which then hurts my profit margin. Yeah. Are the stacks blocks addresses known in advance for the next like 100 blocks so that I could send one transaction for 100 blocks at a low bid. And then I'm okay with it hitting whenever, because I know when it hits, I'm in for the next 100 blocks.
No, they are not known in advance. In fact, they are not known until the time at which you know the next block, the next 2 POX addresses is the time when you are sending that transaction, but you don't know more than 1 block in advance like that.
Nice. Okay, cool.
To answer your other question, like there's another design point here that has not come up that kind of explains why the system is the way this way, that might be informative. And that is one incentive wrinkle in POX is that miners can also be stackers, which means that if they were able to tell when their address was up for payment, they could mine at a steep discount because their Bitcoin's coming right back to them.
Sure.
So we take a lot of steps to make sure that they cannot know that in advance. And moreover, if they try to only mine when their address comes up, they have a very, very like negligible chance of winning. They have to consistently mine to have a chance of winning at all.
No, that's beautiful. I was just going to say, like, great job on this report. Like, what I was going to ask is, has there been a report like this written about stacking? Like, can I read the opposite side? Because I do think there is, like, the way that you laid out profitability or unprofitability in like how many sats am I earning per STX block, I think is like amazing, because I've been trying to think about stacking the other side of the equation of like how many sats per STX am I making? Because then that would inform, because if I can know that, that would then inform me to be like, can I go become a miner and basically try to acquire STX below market price? Like, I've been trying to watch how much miners are bidding versus how much STX is selling for on a sats basis on exchanges to kind of understand, like, that's what's unique about this whole thing, is that the proof of transfer mechanism is almost like setting, like, there's a reason for Bitcoin and STX to have an exchange rate. And there's no other altcoin that has like a built-in like mechanism reason that like informs what the exchange rate is. And that's something that I'm obviously, like, you guys have your brains have been climbing over that longer than mine has. But yeah, report is awesome. Like, I'd love to read one from the alternate side of like stacking as well.
Yeah, I want to second that. Maddie, your report's fucking amazing. I love reading it. I love hearing that. I love watching the talk over and over again too.
Thank you. I appreciate that, guys. I think, yeah, I think I could throw together a stacking report as well. And I think that's also a good point about one, like, I don't want to say at worst, but at least you can always value stacks as if it was a discounted series of Bitcoin cash flows, right? Which you can't value like any other asset like.
Yeah, I'll just second that. What I like about the report is like sometimes you rephrase it and say like in another word. And I think like when like even if I can understand it, it means like if I put my mind to it and I can understand it, I'm not like technical, and it still makes sense to me. Yeah, somehow it's, and it really goes into the details. So I really like this report too.
Thank you. Yeah, it drives me nuts when I read like academic papers and it's like, what the hell are you talking about? Like, where is the connection to, you know, the takeaway, I can see the formula, but where is the intuition, right? And so I try to incorporate that into mine so people don't have that same feeling when they're reading stuff I've made.
Would people mind if I share my screen and ask Maddie some questions? And it's for the people, for the community, and people perhaps not on the call. If you stop sharing screen,
Sure.
Maddie? But anybody else got questions? Cool. So just for the folks at home, can you see my screen?
Yep.
Cool. So we'll run through these quickly because we kind of a little bit short on time. But yeah, if it was mentioned, the cost of attacking stacks chain could be less than the expected payoff. So what's the cost for attacking Bitcoin and attacking stacks in token or USD terms?
So I mean, no one really, or I guess you could quantify approximately the cost of attacking Bitcoin. Making some assumptions about hardware and hash rates and electricity costs. I don't know what the number off the top of my head is that, but obviously, in theory, at least, it'd be easier to attack stacks. And so if we look at like there's currently about like 1.8 million sats per block committed. And so let's say you're a new miner. So in order to be 51% of the total, you need to basically contribute at least 1.8 million more, right? Because you would be 1.8 million out of now 3.6 total, which is 50%. So you'd be spending 1.8 million sats per block to have greater than 50% of the stack's mining power. And now a couple other key important notes come in here. Stacks Jude kind of alluded to it. Stacks has this throttling where it's actually your bidding power is not your like bidding power in the block. It's the last, it's the median of your last 6 blocks. So about over the course of an hour, it would take you about an hour to start actually getting that expected weight of being more than 51%. So what that means is that you would be publicly writing to the Bitcoin blockchain that basically I'm launching a 51% attack. I have now more than 51%. You'd be publicly writing that to the Bitcoin blockchain for a good part of an hour before you would actually be able to reap any benefit from that attack. Yeah, right. So Jude added a clarification in the chat. That is correct. If you're mining consistently, if you're just ramping up, it's effectively the median. But if you lose a block, if you don't mine on a block, yeah, it's the min of your last spend as well. So, yeah, so you would be spending 1.8 million sats for 6 blocks just to even get the chance. Everyone has known about it for the better part of an hour. So they can start ignoring your fork. They could ignore your proposals, your blocks that you mine, and you can't do it in secret. Unlike Bitcoin, where you could like secretly build this hash network and then acquire more hash power than anyone else, and then flip it over to Bitcoin, and suddenly out of nowhere be launching a 51% attack. You can't do that in stacks, and you have to maintain it, right? So in Bitcoin, once you have hash power, you have that hash power. But in stacks mining, you have that hash power, so to speak. You have that mining power because you're spending Bitcoin. So even if you have done this, even if you get to the point of having more than 51%, the network has noticed you for an hour and has time to respond. And even then, you need to maintain that 51%, meaning you need to continue to spend 1.8 million sats per block. And that's even assuming other miners haven't boosted their bids to try to protect the network. So it's rather costly. The costs add up pretty quickly if you do the math. And it's kind of much more secure, even in its current state, than people probably think.
Okay, great. Yeah, let's try a few more questions.
I'll be
You
more
can keep
concise.
sorry?
I'll be more concise on these. Yeah.
Cool. Page 2, I saw a typical miner, number of miners, but I understand it's not just about the number of miners. So what are the sort of important nuances beyond this just this number? I think you also touched on, but yeah, maybe a brief summary.
Yeah, I touched on this when we were going through the report. I mean, I think the biggest nuance is that the total number of miners isn't the only thing that matters. The number of miners it would take to collude to launch a 51% attack matters, right? If it's literally one miner, that's not good. So that's the most important nuance. And that number was about 3.7 miners. It would typically take 3.7 round up to 4 miners to collude to even in theory be able to launch a greater than 51% attack on the Stacks network.
Yeah, I think it's like how much power each miner has, right? If you have like 100 0.1% little miners, they don't do anything. They don't really add up to much power. Whereas
you take a bunch of people getting together to be a threat. Exactly.
Cool. So another one, a break even, it's about 2.5. For one stacking cycle is about 1 to 2 BTC. Yeah, any more info like how that could potentially impact people's decision?
Well, I just think it goes to show like how expensive it is, right? If you compare this to even now, like back in the day, graphics cards were a lot cheaper, but even now, at most, what you're going to be shelling out like a couple thousand for a graphics card to mine Bitcoin. And so like compare this to like a hobbyist just setting up a proof of work miner, you're talking like 4x to 10x type of cost. So I think I think that high threshold just reduces the amount of people who they probably wouldn't be large miners, but in aggregate they could be, right? And so it just reduces like the hobbyist chances of getting in, which I think is what non-custodial pools will, that's the value of non-custodial pools and why they're so important to get up and running.
Yeah, perfect. I think that leads really nicely to the next question. So because you mentioned mining is only for profitable and extremely large miners. So is the goal to increase the profitability and the accessibility of barriers for the small and medium miners? Is that the focus?
That is the focus, yes. And I think this quote actually is, I think it's a little bit out of context, because I was saying that this is the perception that mining is only profitable extremely large miners. And there's an element of truth to this, but it's not entirely true. There are still, as long as you have above that size, in the line above, and there are miners that are much, much larger than that, you're profitable. So mining is profitable for, I would say, like, the medium and higher miners, but it gets more and more profitable the larger you are, which is a problem. And then it's, just outright negative for small miners. So yeah, that's the level the playing field proposals and mining pools are aimed at trying to fix that.
Yeah, and from my understanding, you still want to keep those large miners, still they feel profitable, but you want lots of small and medium miners joining, right? So that their fixed cost is much lower, and that could be helped with Taproot even.
Yeah, for sure.
Okay, so what are the biggest takeaway for this of this report for you?
I think that if I had to pick one takeaway, it was how profitable mining was. Because I think I was also guilty of what everyone was guilty of just kind of like doing the back of the envelope math and being like, oh, it's clearly not profitable, like what, And so that was the biggest surprise. I'm like, oh, wow, well, I didn't think about this. I don't think anyone's thought about this yet, but Coinbase rewards are actually higher. Mining is actually, 15%-ish profitable. So that's the biggest takeaway.
It sounds if you stay in mining, stacks mining over long enough period, it should be profitable, right?
I would say yes, given you're above a minimum size.
Yeah.
I think I think I skipped over the chart in the report, but there's a chart that shows like unless you're large enough that the gas fee you're paying for your Bitcoin transaction is less than 17-ish% of your total bid, you have like no chance of being profitable. So
yeah, so actually the cost of sending Bitcoin transaction on the Bitcoin side, how much the network fee level is kind of important to the profitability, right?
It is important, yes, but it's, even if it, it will always be a barrier. And so the other flip side of the equation is how those miners are treated in the stacks portion of it, because we can't really directly control that side of the equation.
Yeah, cool. So if the three suggested next steps are accomplished well, how would that miner landscape look like? What sort of metric or target would you be looking for? Things in 2.1 upgrade helps?
Yeah, I mean, I think the biggest things are, I'm doing some further follow-up analysis on a couple different options for proposals that would, quote unquote, level the playing field, right? Make it even out the profit margin for smaller miners versus larger miners. And then also what we talked about last week with the Taproot, wallet support, multi-sig support, all those pieces that enable, because it's not just one thing, it's quite a complex endeavor, but all those pieces that enable non-custodial mining pools is a really big thing. So getting all those pieces, getting all those ducks in a row in 2.1 so that non-custodial mining pools can come online, and then also seeing if there's some improvements we can make to kind of level the playing field. Those are the biggest next steps in my mind.
Cool. Thanks a lot. So about yourself, any future work in the pipeline? I think you touched on a little bit from you. Next report.
Yeah. So I've done an analysis. I haven't publicly shared it, but I've done an analysis on one of the leading proposals for change to mining. I'm doing another one for the alternative, so we can directly compare them and see which one we want to go with. And then it sounds like community suggestion need to put together a stacking report as well. So guess I'll do that.
I'm sure like lots of users, not miners, and loads of users. So I'm pretty sure like the wider community will be even more interested in that report.
Yeah, good point.
So what can we help? Is anything like the SIP community or the Stacks user can do to help? Anything we can do to advance whatever you're doing or support?
I think just being actively engaged in the conversation. So there's been a couple kind of mega threads, right, on mining ideas in the in the forum, excuse me. So getting engaged there, making proposals, kind of sharing potential weaknesses or drawbacks that you perceive to different proposals is always useful. Because right now we're at the point where we think we've narrowed down kind of a short list and we need to crunch the numbers on each and kind of see what the expected outcome actually would be. And so getting engaged, once I publish those, offering feedback and engagement on those is really the most productive. So not just being active on places like Twitter and Discord, but also if you're curious and passionate about mining or any of the SIP community stuff, getting on the forum boards, I think is also very helpful.
Awesome. I'll definitely try to direct people to to Stacks forum. It is a really good place to get those conversations and to help. And it's really key topic in Stacks. So yeah, I'll do my best. Lastly, what inspired you to do this report? And could you share briefly the journey from idea to publishing?
Yeah. What inspired me? I mean, a bit of just this conversation about mining, and I'm a data person. I'm a data scientist by kind of trade and also by just personality type. I like to dig into the numbers and build models, not just to describe past events, but also kind of predict things and model how systems work so that you can kind of know the expected outcomes if you push this button or pull this lever. Just kind of how I personally like to think about things. And so when all this conversation was happening, I was wondering and thinking about like, gee, wouldn't it be nice if someone actually went and looked at all this data so we would stop speculating, oh, this might be the case, and actually have some actual answers to go off on. And so I figured if no one's done it yet, then the best person to do it is me. So or best person to do it, right, is anyone who actually does it. I just stepped up and did it, but certainly welcome other people to get involved as well. Not saying I'm the only person who could have done it, but yeah, it was just like that. It was just I wanted to see it, so I can do it. Why not do it? The hardest part probably was scrounging around. I mean, for anyone who's ever done a data science project, you know what I'm talking about. The hardest part was just finding the data sources, compiling them, getting them all into one place. And from there, it was just work, clean up things and start asking the questions and how do I need to represent the data to answer this question and that one. But I think getting more of this meta data about Stacks itself in kind of one dashboard, one place would be helpful to people too.
Yeah, agreed. I think this work has just, I don't know, I saw on Twitter and just hit everybody, and like everybody really appreciate this report. So yeah, it's amazing. And I think yeah, I think we definitely could do with even more people like yourself.
Absolutely.
Thank you so much. So if you want to support Maddie, you can go and support him on Twitter. And if you have anybody who you would like to come on the call, please let me know as well. So yeah, any other place you want to shout, Maddie, how to follow you or support you?
Office hours every Monday.
Oh, yes, of course.
Oh yeah,
Yes.
yeah.
I have office hours where I can talk about tokenomics. If you're, a builder building on Stacks, if you're a builder building on another chain, if you're curious about tokenomics, if you're, just curious about Stacks, office hours on Mondays. Jenny, what's the best place for people to find the schedule?
I can share a link to it.
Okay, cool.
Well, actually, no, I don't have to share a link to it. You can just go to community.stacks.org/events, and office hours are listed there for every Monday. The times change, so Maddie does an earlier time and a later time to try to accommodate as many time zones as possible.
Yeah, so regardless, the time alternates each week so that I cover, every time zone. So I got office hours on every Monday. You can hit me up on Discord and we can find some time. You can hit me up on Twitter. All those are good places.
Cool. I shared the link in the chat.
Wow.
I think Maddie's Discord is Maddie STX.
Yeah, but you need the I'll just drop it in here.
Cool. So yeah, links to Maddie's report you can actually find on GitHub. Because it's too long, I can't fit in here. But anyway, mining centralization thread on Stacks forum, great place, like the best place. Go and chime in. And the reason why I put SIP 000 is because I am asking if what's going on? Sorry. Yeah, so sorry, we ran out of time to do open discussion, but next time we will for sure. I'll skip these and just tell you that I'm looking for CAP members who can contribute from different aspects, different angles, and review the SIPs from a technical perspective, governance, ethics, economics, diversity. So if you're interested and you want to make a mark in Stacks history and, express your expertise in your area, in your field for the SIPs, every SIP you can get to review and post comments, official comments, and vote whether you want to get it through from a draft to accept the stage, or it's from accept the stage to recommended. Please let me know. Looking for CAP, and I'm basically just looking for Avengers, the best of Stacks, and that's it.
Thanks, Hero, for leading a great meeting. We will start sharing these recordings soon too. I'm sure everybody wants to reference this discussion, and yeah, you can find out about it on Twitter once it is up and edited.
Awesome. Thanks, guys.
Thanks everybody for coming.